Mutual and PMI Mortgage Insurance. He is a chartered financial analyst and holds a master's degree in engineering from Stanford University and an MBA from Stanford's Graduate School of Business. Here to speak to us on the overall MI world, ladies and gentlemen, Rob Smith. Give him a big round of applause.
All right. Okay, thank you. Consistent with the theme of the last presentation, I'd like to self-identify as a Canadian American, and that theme, I say Happy Canada Day. July 1st is Canada Day, where we celebrate the struggles that our forefathers went through to gain into. No, we didn't do that. I think we just signed a treaty with Britain when we became a country, so it's not that exciting, but it's a good excuse to have a holiday in July. All right, I'm going to talk to you a bit about the private mortgage insurance industry, a little bit about history and some opportunities, because things have changed. Just like the rest of the mortgage industry, the private MI industry went through a bit of a struggle, I guess, during the downturn, but now we've reemerged and are ready to help you guys drive some volume, hopefully. Let's see how I turn it on. That would help. Maybe. There we go. I got it. Yes. By the way, these slides have been cleared by our legal team. So there's just in case you're worried about the copyright, we figured George Lucas won't be watching it, so we're pretty safe. So obviously the industry was under attack during the Great Recession. 3 of the 7 providers are forced into runoff. The remainders are really on life support. The survivors pulled back heavily on guidelines, increased pricing, really to rein in and maintain capital. Credibility was questioned. Obviously, 3 of 7 people collapsing doesn't help. And due to the breach, stepped the FHA to support the low down payment market. And we can see this here. This is a graph of the insured loan market share between private MI, the FHA, and VA. And you can see the huge drop-off in the private MI industry during the crisis and the huge increase in FHA. However, see, I told you I stole that from George Lucas. As the crisis subsided, we had some new entrants join, including ourselves and a couple other entrants. The existing providers who survived recapitalized, raised new money. And the GSEs increased their oversight of the industry. Being the largest insured of the industry, they kind of took it upon themselves to make sure we were in a safe and sound position and in a position to pay our claims. The GSEs themselves, introduced greater transparency around their repurchase demands, so people have more certainty when they sell a loan to the GSEs. Conventional with MI became a viable solution for low down payment transactions again. And our market share recovered. And we're seeing that now, as you can see from the depths, the private MI industries started to recover some market share. From 2008 to 2015, we really had no capital standards that we could use to run our business. Prior to the crisis, the rating agencies really dictated how much capital we had to hold. There's no, we're a private industry, so there's no government mandate in terms of how much capital we have to hold. Rating agencies obviously didn't do such a great job with rating us as with other areas, and they fell off, in terms of their importance to our industry. And, we didn't really have any standards. The existing players are trying to survive. We started the industry, and, at the time, the GSE said, just, don't get too much risk before you, use up all your capital. But we're coming out with something new. So finally, last year, they came out with new standards. And with these standards, it gives us the ability to price our product more efficiently and more exactly. And that's really created some tremendous opportunities for mortgage lenders and the borrowers. And I'm just going to go through a few examples here. So one of the things, obviously, in this area, a lot of the mortgages are high balance. I believe we are standing in the county that has the highest conforming loan limit at $721,000 and $721,050 in case you need the extra 50. I'm personally a big fan of jumbo mortgages, high balance mortgages, which is good news because I set the pricing. So we do not have any additional charges for high balance loans at any level, whether it's 625 or 1.625. You know, there's been plenty of evidence through the crisis that jumbo mortgages perform just as well as conforming, all else equal. So, you know, at the end of the day, you know, it's going to come down to your underwriting anyway. The size of the collateral generally doesn't make too much difference in the performance. So if you see this example, you know, at one time, prior to the crisis, a high quality borrower who just happened to have not much down payment but wanted a big mortgage, they'd have to pay a lot, you know, 74 basis points in premium to put 5% down. And that really consisted of really two charges. They had, you know, the 54 basis points base rate, and then they had another 20 basis points, or almost a quarter in rate, to get the private MI. Well, now the base rate's $41, 41 basis points, and we don't have a charge at any amount. So, you know, that's for that borrower, you know, it's almost $200 a month in this scenario shown, and you know, that's a lot. Even for a $3,000 a month payment, it's still you know, over 5% of the payment you're saving. So, you know, we don't do a lot of real jumbos. We're starting to do a lot more of the high balance conforming now that the agencies have changed their guidelines. But, you know, we certainly welcome those loans. We feel they're good quality. In fact, I had a story. I had we had an exception to our policies. You know, we had a lender somewhere in Florida or something, and someone asked to insure a mortgage for $2.5 million. So our underwriter was like, okay, well, you know, it looks pretty good, but they want to get my input as the pricing guy, as the value of the risk. So I looked at it, and the borrower was this doctor who specialized in some field that I couldn't even pronounce. Probably the only person in the world who knew how to do this thing. And the guy made $100,000 a month. And I thought, well, he's probably a pretty good credit. So I don't think they ever did the mortgage, but we proved it. So I know, you know, again, in this area, you do a lot of jumbo lending. A lot of it's probably high balance conventional. Some of it's portfolio lending. Yeah, it's not an area, you know, that we're afraid of either as a company or generally as an industry. We do have guidelines for jumbo mortgages, and you know, we understand. Look, sometimes people have good incomes, they have good credit, they just don't have a big down payment. So, you know, don't think you need 20% down to do a jumbo. We can accommodate you. Another opportunity, kind of the same theme. You know, short-term mortgages, and this is a kind of an interesting area. I know one of our competitors has tried to push this a bit, but you know, I just use a small loan balance as an example. But you know, again, often the barrier to home ownership is down payment. It's not credit, it's not income. It's just having the money. I myself was in that boat one day, so I understood it. You know, if you look at the pricing on a 15-year mortgage, so this is one of the things, you know, when we got our new capital guidelines, the GSEs recognize that shorter-term mortgages are much less risky. So they impose much smaller capital charges on us. you know, if you kind of take the minimum down payment that you can do in a conventional loan and do it for 180 months, you don't have as much of an MI charge. You know, before, the old MI premium was 102 basis points. You know, so here's a 15-year mortgage, a 760 plus borrower who just happens to have 3.5% to put down. We're gonna charge them a point in rate, effectively. It's kind of crazy. You know, now we're charging about 3/8, less than 3/8, in fact. You know, there are actually no LLPAs on 15-year mortgages. So, you know, that's a huge savings. You know, the payment, the MI payments cut in more than half. And the other thing to note is for a short-term mortgage, this loan in this particular scenario would amortize a 78 LTV in 41 months. That's just under 3.5 years. Once the loan, if you're doing borrower-paid mortgage insurance, under federal law, once the loan amortizes to 78, the mortgage insurance is cancelable. So in this scenario, you can put a borrower into a mortgage, pay the mortgage insurance for 3.5 years, and it's done. You know, it's a good risk for us. There's really not a lot of risk. You know, there's a really fast amortization these days, especially these days with low interest rates. You know, 10 years ago, if rates were double this, the amortization time is a lot longer. It's more than double it is now. With low interest rates, you can amortize really quickly to 78 with a short-term mortgage and get rid of your mortgage insurance. We're okay with that, and the borrower is more than okay with it. So, and they don't, you know, if rates do go up, they can drop their MI, not have to refi to get out of it. So it's a good option for them. And again, with the new capital charges and the new regime, if you will, in the mortgage insurance industry, we've really made it a lot more affordable to do that. We're charging a premium that really is much more commensurate with the risks we're taking on. And then, you know, low down payments. You know, statistics vary, but I think most FHA borrowers put down the minimum, or, you know, at least over 40% of them put down the minimum. You know, of those loans, about a third of them have a FICO score of 700 above, and nearly 12% of FICO scores over 740. Again, with our new pricing, the conventional option becomes much more attractive. You know, again, this is a high FICO scenario again, but you know, under the old MI option, we would have charged 105 basis points for a 3.5% down borrower at 760 plus. We're now charging 55, so that's just about half. And all of a sudden, what would have made sense to do FHA now makes sense to do conventional by, you know, almost exactly $100 a month. So, you know, again, we've changed a lot. And a lot of these changes are very recent. You know, we started changing our pricing last fall. Some of our competitors followed at different paces, but they, you know, by April, most people have changed. So it's a relatively new development. You know, I know our salespeople are out trying to educate everyone, but I figured I'd come here and, you know, point out, you know, there's a lot of opportunity out there to look at MI options and drive volume. Not only does it make the borrower, you know, give the borrower a better payment, but also you can help qualify more borrowers. Obviously, the DTI goes down as the overall payments go down. You know, some other additional benefits. You know, being stronger counterparties. You know, comes with a willingness to pay claims. And we also bring other benefits. You know, we do insure outside the GSE credit box, as we mentioned. We're not just conventional mortgages. We do a lot of portfolio insurance, jumbo loans. Again, I love jumbo loans personally, so we're willing to do those. Different types of programs like doctor loans, where, you know, the income is a little harder to verify. You know, we're used either for credit relief or sometimes regulatory capital relief on portfolio products. We do offer a lot of education. One of the things we've done recently is help educate borrowers, or loan officers rather, on reaching the millennial borrowers. I know some of our competitors do that sort of thing as well. And again, as I mentioned, you get to terminate your mortgage insurance at 78, which again, as rates go down, that time frame becomes closer and closer to reality. Even for a 30-year mortgage, you can amortize really quickly. So these are just a few examples. Any of our salespeople, either whether for us or anyone else, be willing to help you go through different loan examples and see where some of these new opportunities lie. But so I'm trying to grow the pie rather than grow our slice. But I think there's a lot of borrowers out there who aren't reached because they don't know that these options are available to them and that they're very affordable. So that's really all I have. I promise to be really brief, so hopefully I'll catch us up. I do want to say thanks for everyone for letting me come here to speak today and share this time with you. I did look up my Hawaiian name before I got here, so I look it up. Now, so what you guys got to tell me though, so Robert is Lopaka. Now, I'm going to check with someone to make sure that that's really true, or whether these websites are trying to pull one over on me. Lopaka really means idiot. So I said, hey, my name's Lopaka. Anyway, that's all I have for now. We're always happy to answer questions. Holly and Dennis, hopefully, and reach out to them if you want any more examples or other ways we can help you drive more volume. Yeah, questions, that's right. Yeah, I know. Well, that's a battle we fight a lot. Oh, sorry, I'll repeat the question. Yeah, the question was, what's the possibility of getting the income tax deduction limit increased over the 100,000. We have a lobbying organization. That's one of the things we've been working on. Making it more like mortgage interest credit. But it's hard to tell in Congress. And obviously, if we could do that, that would benefit conventional with MI and FHA loans, MBA loans too. So we keep lobbying. Oh yeah, go ahead.
Hi. I just wanted to kind of make an announcement that the Federal Home Loan Bank System has partnered with National MI for a special training program that we put together, and Holly Rittenhouse worked with us on this. And we just sent out the invitations this last week, and both Holly and I were shocked at the amount of people that have already signed up. So we wanted to let everybody know about it. We would obviously welcome anyone here to participate in it, but we're doing deep dive classes and education and training on collateral underwriter. So if you have people that are using collateral underwriter, but they only know how to use it so far, and I think all of us are very new at using collateral underwriter, or you don't have the experience and expertise to use the collateral underwriter web interface tools, which are absolutely amazing. And if you haven't seen or experienced what you're capable of doing with that, I would highly encourage you to participate in these. And I think Holly can share a little bit more detail about the content of how we're doing this.
Thanks, Shelley. Thank you all so much. So it's a 5-part series, as Shelley said, collateral underwriter. Fannie Mae is actually doing the live webinars. We've chunked it down to 45-minute sessions because there's only so much we all can take in one day. And they're every 2 weeks. So we're starting on July 5th. And as Shelley said, we'd be more than glad to have any and all of you participate in this. We already have, we just sent out the invitation, over 100 people with the Federal Home Loan Bank signed up. So thank you very much. Any questions? Give me, Shelley, your card, and we'd be glad to get you the invitation.
All right, any more questions about the exciting world of MI? George Lucas? Anyway, no. Okay, good. Well, thank you again. Appreciate it.